So we are now to the second set of rules for accounting, which are called qualitative characteristics. So we're going to try and remember these by giving them each a letter, Q for qualitative characteristic, and a number, in this case 1, because the first one is relevance. And the category we're dealing with is the category that tells the accountant how to prepare the 3 financial reports. Whereas with the accounting assumptions, that was more about how to record specific transactions. Should we record them? When should we record them? How much? Etc. This one's more about the reports. Should it go in the reports? So what is relevance about? Well, it basically says that accounting must be relevant. When we define this, though, we don't really want to use that word. We don't use the word in the definition. So what we're going to say is accounting must be capable of making a difference to the decisions made by users by helping them make informed decisions. There are 3 tests to determine if information is relevant. 1, materiality test. Is it large enough to influence a decision? 2, accounting entity test. Is it for this entity or another entity? And 3, is the bit of information, does it pass the period test? Is that bit of information for this period or another period? So in terms of how we define this, a couple of things. We don't need to mention these tests when we're defining it. Okay, this is just to help us figure out if something, a piece of information is relevant. What we want to look at is this bit here. Informed decisions, not right decisions. We can't always make the right decision, or not best decisions. We just use the word informed decisions. So what is relevance about? Well, basically what we're saying is we want to include any information that's going to help the user make an informed decision. So they're the words in blue there that we really want to include in our definition. So how does it work? Well, basically what it's saying is, here's what we should include in the 3 financial reports, and we'll go through these in detail throughout the course, but for now we'll say the first one is the income statement. How much profit did we make? The second one is the cash flow statement. How much money did the business make? And the third one is the balance sheet. What does the business own and what does it owe? So what we're talking about with relevance is we've got one bit of financial information, say a sale, or the amount of an asset, or somebody's wages, something like that. That's a bit of financial information. And what we're saying is, do we need it in order to make an effective decision or an informed decision from these 3 reports? Now, if we do need to include it to make an informed or a good decision, we're going to say yes, that should be included in these reports. Now, if we don't need that bit of financial information to make a good decision, we can exclude it from the reports and chuck it in the bin. We don't need to include it in these 3 things here. So relevance is basically asking a yes or no question. Is something relevant? Is it going to help us make a good decision? Yes, include it in these 3 reports. No, chuck it in the bin. What else do we need to know? Well, is something relevant is kind of the 3 test, really. We've got the materiality test. Is it big enough or sufficiently important enough that if we exclude it, we'd make a less than optimal decision? Accounting entity test. Is that bit of information related to this entity and not the owner as an entity, or maybe another entity owned by the owner, so the owner might have multiple businesses? And lastly, there's the period test. Is this information related to this reporting period and not another reporting period that was either in the past or in the future? And together, these are going to help us figure out if something is relevant or not.